How do you make sure a bank doesn't just, well, run out of money? It's a huge problem every country has to solve, but the answers can be worlds apart. So today, we're going to look at how two major economies, Nigeria and China, tackle that exact problem with two completely different philosophies.
At the end of the day, that's the fundamental challenge, right? If too many people show up asking for their money all at once, a bank can literally collapse, and that can trigger a massive crisis. So central banks everywhere have to create rules to stop that from happening. The real question isn't if you need rules, it's what kind of rules work best.
To really get our heads around these two approaches, we're going to think of them as two very different characters. On one side, you've got Nigeria's approach, the guardian. Think protective, watchful, totally focused on defense. And on the other side, there's China's approach, the conductor. This one is all about managing a giant, complex orchestra, steering the entire system in real time. To see just how different they are, let's start with Nigeria's guardian.
When we talk about Nigeria's strategy, it is all about clarity and strength. It's a system designed to be super easy to understand and, frankly, brutally effective. Just picture a fortress with one very, very thick wall.
And what's so striking about this is just how simple it is. I mean, in a world full of ridiculously complex financial regulations, the Central Bank of Nigeria, the CBN, pretty much hinges its entire liquidity framework on a single, non-negotiable rule for its banks. There's no gray area here.
And this is the magic number, 30%. As of September 2025, this is the minimum liquidity ratio every single commercial bank in Nigeria has to maintain. It's a hard and fast rule. But what does that actually mean?
Okay, so think of it this way. The liquidity ratio is basically a bank's safety buffer. It means that for every $100 you deposit in a Nigerian bank, that bank must have at least $30 ready to go in assets that can be turned into cash almost instantly. This is money specifically set aside to handle withdrawals.
And that really gets to the heart of what the Guardian is all about. It's a direct, prudential safeguard. The goal isn't some grand plan to steer the economy. It's just to make sure each individual bank is strong enough to weather a storm. It's about keeping things stable, one bank at a time, so they can always meet customer demands.
All right, so now let's switch gears and meet our second character, the conductor. China's central bank, the People's Bank of China, or PBOC, has a completely different philosophy. It acts less like a guardian for each bank and a whole lot more like the conductor of a massive, sprawling economic orchestra.
So, if Nigeria's playbook has that one big, bold rule, China's is, well, it's the complete opposite. There is no single liquidity ratio you can point to. Instead, the PBOC uses this dynamic and pretty complex set of tools to manage the cash flow for the entire financial system.
Let's take a little peek inside that toolkit. First up, for the really big banks, China uses global standards like the LCR and NSFR to build a strong foundation. Second, it has this key policy tool, the Reserve Requirement Ratio, or RRR. That tells banks exactly how much cash to park at the central bank, which then affects how much they can lend out. And third, it uses active market operations, like its medium-term lending facility, to constantly fine-tune how much cash is in the system. It's a truly multi-layered system of control. So let's drill down on that first one, the LCR. This rule, which is for China's bigger banks, is a global standard. Think of it like a financial fire drill. It's a simulation to make absolutely sure a bank has enough top-tier, high-quality assets to survive a full 30-day panic all by itself. But remember, it's just one piece of a much, much larger puzzle. And this right here, this quote tells you everything you need to know about the conductor's mindset. The PBOC isn't just trying to make sure one bank is safe, it's actively working to make sure there's plenty of cash flowing through the entire system, keeping the whole economy humming along and credit flowing.
Okay, so that's the theory. But what does this look like in the real world? Well, we've got a perfect example of the conductor in action from just last year. Get this, in one single operation, the PBOC injected a net 300 billion yuan. That's about $41 billion straight into the banking system. This wasn't some passive rule sitting on a spreadsheet. This was a deliberate action, a flick of the conductor's baton, making sure the orchestra had exactly what it needed to play.
Okay, so we've seen the Guardian's simple, powerful rule, and we've seen the conductor's complex active toolkit. Now let's really put them side by side.
You can really see the contrast when you lay it out like this. Nigeria's approach? A single, fixed ratio. It's predictable, but maybe not so flexible. China? A whole complex toolkit, a bunch of acronyms, that gives them immense control, but it can be harder to see what's going on. But the most important difference is the goal. Nigeria is focused on the stability of each bank as a safeguard. China is focused on steering the whole system as a tool for its monetary policy.
So you gotta ask, right? Why on earth are they so different? Well, it all comes down to two fundamentally different ideas about what a central bank is even supposed to do.
And honestly, this is the absolute best way to picture it. Nigeria's 30% rule is a protective shield. It's handed to every single bank to defend itself. It's a static defensive tool. China's toolkit, on the other hand, is a steering wheel for the entire economy. It's dynamic, it's proactive, and it's used to navigate constantly changing economic waters.
So, at the end of the day, that's what this all boils down to. Neither approach is necessarily better, they're just built for totally different purposes. The Guardian model values simple, tough rules for the sake of stability, even if that means giving up some flexibility. The Conductor model uses a complex, hands-on toolkit to get broader economic control, even if that means things are a bit less simple and transparent.
And that leaves us with one final, big question to think about. As the world gets more and more interconnected, and let's face it, more volatile, is the future in the simple, unbreakable shield, or is it in the nimble, all-powerful steering wheel? The answer to that is probably going to shape global finance for decades to come.